but that's not our concern here. The research and development costs that are in the income statement, given the definitions they've just given you of operating, investing, and financing, research and development, intuitively, where do you think that should be classified? Operating, related to current period revenue, investing, acquiring and producing long-term assets, or financing? Well, they say surely that should be investing. R&D is to try and generate long-term assets. Where is it in the income statement? It's in operating. They're raising the issue that perhaps as an analyst, if you're using the income statement, you might want to think about separating out R&D and saying it's not operating. In the cash flow statement, also operating. So even if your valuation model starts with cash flows, as it very well may do, then again, R&D is going to be shown as operating. It's going to reduce CFO. Depreciation, amortization, I think you've got the idea of what they're trying to tell you here. Intuitively, it's to do with assets. Surely that's investing, but once again, it is operating in the income statement. To be fair, it's not in the cash flow statement. Now, before you jump on me for that, I am right. It is not in the income statement because it's not cash. Yes, it is adjusted. If you're using the indirect method of calculating CFO, you'll have to add it back to get to CFO, but you're adding it back because you don't want it to be in the cash flow statement. So it's not really an issue if you're starting your valuation model off with cash flows. It is, however, an issue if you're using the income statement. How do you get around it? The much beloved EBITDA. Do you use EBITDA? If you don't like the fact that depreciation, amortization, and in there, maybe you use EBITDA. Also gets around the issue of people having different depreciation and amortization policies. Interest expense, intuition. That's to do with debt. Surely that should be financing. In the income statement, that is not an operating cost, to be fair. But we don't have a separate section in the income statement that says financing, but it is below operating profit. Cash flow statement, interest expense, operating. That is certainly true. Under US GAAP, IFRS, if you've read that section, you know we have a choice. We could throw that into CFF if we wanted to, so it might fit with your intuition. Income taxes, well, I don't know. I don't want to look at that as part of my operating profitability because it's really not something I control with my business model. Yes, I will probably engage in sensible tax planning, but I don't want as an analyst to say part of my business model is the taxes I incur. So I just don't want it in operating, and it isn't. In the income statement, it's the last line or one of the last lines in your income statement. It's not operating. In the cash flow, it is part of CFO. It is operating again. IFRS might give you a little choice, but not for income taxes that are generated from your revenue. That will be in CFO. So be aware there are issues which may lead the analyst to messing about, changing up the figures they use from the income statement to get a better idea of operating profitability. Certainly you'd want to start with EBIT, so these two on there, but you may go as far as EBITDA. Now, that said, that we are going to want to mess around with the figures a little bit, we can at least get the figures we need from the income statement, but are they useful? How are they categorized in the income statement? The most useful way to categorize them for us as analysts would be to show them according to their behavior with output. Are they variable or are they fixed? Because if they are fixed, they add risk. The higher your proportion of fixed costs compared to variable, the more volatile your operating profit will be. Fixed costs, as the name suggests, are fixed. If you can sell more units, you can increase your revenue without increasing fixed costs. Conversely, if you don't sell the units you need, your fixed costs don't drop and you make big losses. If your costs are mostly variable, as your sales go up, so do your costs. Makes your operating profit less risky. You can measure how risky using the degree of operating leverage, which again we've seen before, and we'll revisit briefly here. Now that will be useful. Sadly, it is not what we get. IFRS and US GAAP both say in the income statement, costs should be split by nature. Categories like compensation, raw materials, merchandise costs, office supplies, etc., or by function. Function is allowed by accounting standards and preferred by most businesses, most industries. So you see the classic cost of goods sold, sales and marketing, general and admin, and so on. This is what we are intimately familiar with from FSA. It would be nice to have variable and fixed. We don't tend to have it if we are a sell-side analyst using publicly available information. That said, you may be an analyst working within the company, doing some business analysis for the company, or you may have access to this information. If you do, what can you do with it? A couple of things. First of all, you can define an operating profit like this. Q, the quantity you sell, the units you sell, multiplied by the price minus variable costs. Price minus variable costs is known as contribution margin. They make the hopefully obvious statement that your contribution margin must be positive. If it isn't, it's costing you more to make an item than you can sell it for. And you may recall from economics, if that occurs, you should just shut down immediately. Because every time you make a product, you cost yourself money. The contribution margin has to be positive, minus the fixed costs that you incur. In the long run, you must sell enough units to cover your fixed costs with your contribution margin. Bit of break-even analysis again, kind of thing you've seen back in economics, whether to shut down in the short run, if this is negative, whether to shut down in the long run, if you can't sell enough with your positive margin to cover fixed costs, or continue an operation, if this is positive. So once again, we can see how important it is to look at the split between fixed and variable to measure your degree of operating leverage, DOL, which we can define as the percentage change in operating profit over the percentage change in sales. How sensitive is operating profit to a change in sales? The higher your fixed costs as a proportion, the more sensitive operating profit will be, and the higher your operating leverage will be. But, just to go full circle, as we said, practically, we don't have the information. We don't have output volume. We may, even if we have the information, have several product lines with different fixed versus variable costs, and it's all been distorted by aggregation. So quite often we can't really do this unless it is disclosed. Unless the industry typically tells you their volume of sales and their price per sale, their variable and their fixed, which may happen in some industries. So we have an example here from the oil industry. Fictional, to be fair, so it proves nothing. But as the module says, these are typical disclosures from the oil industry. What do we have? And I've kind of stylized an example here from the notes, and we'll talk about why in a minute. But this is the kind of information they show you. We have volume and we have price to give our total revenues, volume times price, obviously. We have our production costs per barrel. Add those three together, you get the 1724. They're your variable, less our other operating expenses, depreciation, general and admin, together are going to give you your fixed. That would be 1275 and 150, 1425. With the quantity, the price, the variable costs and the fixed costs, I can calculate both my operating profit and my degree of operating leverage. So let's do that. Starting with the contribution margin. Your contribution margin is P minus VC. We'll do it per barrel of output. Price, we'll take the average for the year at 49.66. Variable costs, 1724. Contribution margin per barrel, 32.42. It is indeed positive. Excellent. But was it enough, given that we sold 154,812 barrels, given that volume, was it enough to cover our fixed costs and make an operating profit? Let's take a look. Be careful with your units here. We are given the sales volume in thousands of barrels and our fixed costs in millions of dollars. So let's work in millions and say we sold 154.812 barrels. P minus VC we know is 32.42. We just worked that out. Minus our fixed costs of 1,425. Did we turn an operating profit? We did. 3,594. What about the risk attached to that profit? It's volatility. Can we measure that by calculating the degree of operating leverage? Well, this is how I'm going to do it. Be aware you can read through the module and they'll say, oh, well, let's imagine prices change like this, volumes change like this, and we'll work out retrospectively the degree of operating leverage. Well, that's not really how it works. Degree of operating leverage is about fixed versus variable costs. And all I want to change to assess the risk of my mix of fixed and variable costs is sales volume. I want to keep the price the same. I want to say today, right here, right now, without any change in price, by how much would my operating profit change given a change in sales volume? So that's the exercise I'll do. Slightly different, as I say, than you'll see in the module, but this, I think, explains the degree of operating leverage better. Let's change sales volume by 10%, increase it by 10%. So we're going to take that 154.812 and we're going to up it by 10%. That would give us a volume of 170.293. I'm not changing the sales price. That's key. So I'm not changing my contribution margin. Obviously, fixed costs don't change. They're fixed. And that will give me 4096. What's the change in operating profit for a 10% increase in sales volume? It's 4096 minus 3594, 502. Now, to allow me to calculate operating leverage, I'd like that as a percentage. Where did we start? We started at 3594. That is a 13.97% change in operating profit. What's my degree of operating leverage? Well, we defined it as the percentage change in operating profit divided by a percentage change in sales. I have a 13.97% change in operating profit given my 10% increase in sales. My degree of operating leverage is 1.397. That's one way to calculate it. If you'd like to calculate it a little bit quicker, I said earlier on, it's just a function of your fixed versus variable costs. So you could actually just calculate it this way. I've got a little bit of space down here. Let's do it here. You could say, let's take my quantity into P minus V. Just my quantity multiplied by my contribution margin. That gives me my profit when I've deducted only variable costs. That would be, I can just work backwards from here, my 3594 added, or rather with the 1425 added back, that would be 5019 divided by my profit after fixed costs. So it's really just my profit before fixed costs divided by my profit after, which we know was 3594. So right here, right now, today, 5019 divided by 3594, 1.397 is my degree of operating leverage. So looking at this company today, looking at this oil company, I could say, if you were to increase your sales volume by 1%, you could expect your operating profit to increase by 1.397%. Why is that? Because a proportion of your costs would remain fixed. The bigger that proportion, the larger your degree of operating leverage, the bigger the change in operating profit. So the behavior of costs with regards to output would be a useful set of disclosures, but we don't tend to have it. We tend to have it by function. That is, as we've said, the typical income statement. So how do we interpret that? You can look at it and say we've got revenue less cost of goods sold. They are mostly variable. Not completely, but mostly. So your gross profit is actually a good approximation of contribution margin, and you could just work with that. Then you have operating expenses, which are mostly fixed, such as your sales, general and admin, R&D. Now, you might immediately look at that and say, well, hang on. Some employees are on bonuses. Some are on commissions. Salespeople are on commissions and so on. So yeah, this is mostly. None of this is accurate. It's not perfect. We prefer to have strictly fixed, strictly variable, but we don't. Gives you EBITDA less depreciation and amortization. If it's straight line, they will be fixed. And that gives you EBIT or operating profit. These two are the same if you have no non-operating bits of income or expenses. So you can kind of figure it out using the income statement. It's just not going to be completely accurate. In the long run, the major drivers of these costs is output. Doesn't matter whether it's variable or fixed. So we can talk short term. Still, if you want to grow, you're going to have to increase your fixed cost base. So even when we say things like depreciation, straight line, it's fixed. If you want to double in size, you're probably going to need another warehouse, more transportation, etc. So you don't tend to get, even when costs we say, are fixed, you don't get strictly fixed costs. As the company grows and output grows, so do those costs. You can, however, manage it and get benefits from economies of scale. Economies of scale occur when your cost per unit decreases as your output increases. Tends to be as a result of spreading those fixed costs over more units. And you tend to get jumps and say, oh, okay, if I have to double the factory, yes, my fixed costs go up, but if I can more than double my output, the cost per unit will come down. Economies of scope, your cost per unit decreases as the number of product lines increases. That's when you can spread your cost centers over several different product lines. So you have central payment processing, etc. You can use that for all of your product lines. You get economies of scope. As an analyst, a key part of your business model. As they grow, and we can see that Warehouse Club was growing, as they get more and more and more and more stores, maybe sell more lines, different items, do they experience economies of scale or scope? How do you spot it? Well, quite simply, see what happens to their margins as they grow. If as they grow, they're coming down, they are experiencing economies of scale. For scope, look at the standalone unit, see what you'd have to allocate as costs to that unit standalone, and see what they're doing within the integrated company. If they're better off within the integrated company, then they're experiencing economies of scope. Well, how does all of this look for Warehouse Club? What should we be doing? Obviously, identify the different types of costs, and then the key is to look at the trend over time. As we've said, the main driver over time is output. Let's see what's happening to output, and let's see what's happening to those costs, and this word again, what's driving them. So for Warehouse Club, and for most income statements that you'll see, the biggest categories of costs, cost of goods sold, SG&A, sales, general admin, and depreciation, amortization. The drivers, COGS should obviously be driven by revenue, and to a certain extent, mostly so should sales, general, and admin. Maybe fixed elements, as we've said. Depreciation and amortization, that should be fixed. Gross fixed assets. Historic costs, we're assuming here straight line. What can we look at? What metrics can we use to assess what's going on with these relationships? Cost of goods sold to revenue. We know and love that, gross margin. SG&A to revenue. SG&A as a percentage of revenue. It's just like your SG&A margin, if you will. And depreciation amortization. You'd want to see gross fixed assets divided by depreciation, the useful economic life. That will tell you your depreciation as a proportion of your gross, your historic cost of fixed assets. Specifically for Warehouse Club, they also disclose this category of costs, store opening costs, given they're opening stores every year. Should be related to that, obviously, so a good metric to look at. Cost per store opened. How is that trending? Membership fees. I know that's revenue, but there should be costs associated with it. How do you generate those membership fees? How much of this SG&A could you split out between the cost of selling your goods to get revenue and membership fees? I don't know. Nothing's provided to us, but I just think if we're leaving all of the costs in here and leaving membership fees as a standalone bit of revenue, we are losing a little bit of data in there. We're distorting that gross margin a bit by just putting membership fees separate. But we don't have it, so we're just lumping it all in together. Looking at exactly those metrics for Warehouse Club, what do we have? Top left, gross margin. So this here is our gross margin. Nothing too exciting. Pretty steady over time. Now, be aware that doesn't mean things are bad. We've increased sales over time. Remember, we had a lovely big upward sloping trend of sales. You can also see from the bars, we have a steady upward trend of COGS. But the fact that gross margin is pretty steady means that COGS are increasing in line with sales. Sales appear to be the driver. We're not losing control of them. It's a steady percentage. And if you can keep it as a steady percentage whilst increasing sales, you will increase the absolute value of profits. Top right, SG&A, in absolute terms, again a steady trend. As a percentage of sales, pretty steady, even decreased a little bit. SG&A itself is going up. The margin is either steady or actually going down a little. You're certainly in control of your selling, general, and admin expenses, which is good. The more stores you open, the bigger you get, the more difficult it is to stay on top of those admin expenses. Looking at depreciation, bottom left, the useful life. Once again, an upward trend in absolute cost of fixed assets. Not much of a change. I've exaggerated that at the end there. It kind of went that's a bit steadier than I made it look. There's not much change in your useful life. As a percentage of your gross cost, depreciation and amortization is again holding steady. No big changes there. Finally, bottom right, cost per opening. Taking your opening costs in total divided by the number of stores you opened. That is not steady. It's kind of all over the place. I've added an extra wiggle in there just for dramatic effect, but you can see the point. It is increasing over time. Good, bad, indifferent, just begs the question. What it suggests to me is that I am missing a key driver. All of these suggest that I have the driver. It's revenue. As revenue increases, they are maintaining a percentage of revenue for gross margin for SG&A. As gross fixed assets increases, depreciation increases in line. I've got the drivers. I understand it. Not so much for the cost of opening stores. You would think dividing opening costs by number of stores opened would give you a steady line. They're increasing for some reason. I just want to know what the driver is. To be fair, it's not a huge expense in the grand scheme of things, but still a question I want answered. What driver am I missing there? On to the second part of the LOS, working capital. And this will take us no time at all because we've seen in financial statement analysis everything we need for working capital. It's the activity ratios. DOH, days of inventory on hand, DSO, days of sales outstanding, and payables days. You can combine those three into the cash conversion cycle. And we have the data for Warehouse Club. So let's use that data to talk about the conclusions that we'd make. What do we have? Days of inventory on hand. Let's start with that first, just doing a little classic timeline. So here is where your goods arrive, your raw materials. Let's just make it clear. Obviously for Warehouse Club, they're selling on, so it's a retail, so it would just be goods. But in a more general sense, the raw materials arrive. And here, they are sold to customers. The time they spend in your warehouse or in your retail premises is your days of inventory on hand, how long they spend there. What does it look like for Warehouse Club? DOH is that little dashy line here. It looks like I'll just kind of use this one because it's closest to the scale, so I'll do it for 2010. You can see there it looks like it's about 30 for DOH. Downside, you don't get the cash straight away. You sell the goods to your customers, it takes a while for them to pay. So between selling them and receiving cash from your customers is your days of sales outstanding. Now, DSO for warehouse, and I know that it's staring you in the face there, but if we just pretend we haven't looked at it yet, this was the benefit of assessing the business model. I know this is a very obvious one. It's a retailer. Customers turn up to their premises and they buy stuff and they pay for it. But you've set your expectations. I am now going to look at this chart and expect to see a very, very low days of sales outstanding because people pay up front. Let's take a look. DSO is the solid line there. Looks like it's about 4 down there. Makes sense. I wasn't expecting it to be long. If I'd looked at that and it was large, I'd be, oof, what's going on there? That's odd. So between your raw materials arriving and collecting cash from your customers is 34 days. The good news, you don't tend to pay for your raw materials immediately. They arrive in the warehouse, but you don't pay for them immediately. You have credit from your suppliers, you pay there. This distance here is your payables days. How long does it take you on average to pay your suppliers? Payables days, DPO they're calling it there. Days of payables. That dash is up here. It's this one. That looks like it's about 33. I'm going to knock that off to get my cash conversion. That's 33. The gap. So my timeline here is a bit off. If that's 33, it's longer. It goes all the way to about there. This gap is your cash conversion cycle. That's when you pay. That's when you receive cash. 34 days from the raw materials arriving to collecting your cash. 33 days between the raw materials arriving and you paying for them. That's about 1. I can't read the exact numbers off this graph, but it looks like it's about 1 day. And that's what I would have expected. Remember all of the chat about bringing goods in from their suppliers on a pallet, just dumping it into their retail outlet on a pallet, and customers picking up and paying for it immediately. Their cash conversion cycle is extremely short. That minimizes their working capital and minimizes the cost of their working capital. In fact, if we look at the diagram bottom left, these numbers are all negative. They have negative net working capital, probably more payables outstanding than they have inventory and receivables. Final LOS then, capital investments and capital structure. We've looked at revenue, we've looked at operating costs and working capital. Let's now look at their finance. And we'll start by thinking of what their long-run aim is. What are they trying to do? I say they, what's the firm, the company that we're analyzing trying to do in the long run? Earn more than it spends. That comes down to, when you look at your finance, getting a higher return on capital invested, ROIC, than your cost of capital, the WACC. Make sure your return on invested capital is higher than it costs you to raise that capital. If it is, you're making economic profit. As we've said, it's difficult if you're in a very competitive business to maintain that economic profit long run, to have it positive, but that's your aim. Let's think drivers. What drives your return on invested capital? Well, what you use it for. Does it just sit there as cash on hand? If it does, it's just costing you money. Do you have net working capital? If it's positive, sat there is a use of capital. It's costing you money. Capital expenditure, you're using it to generate revenue by investing in projects. Acquisitions, you go and buy a project effectively. You go and buy maybe another company division. to try and generate more revenue, or you may pay down some of your debt or give money back to your providers of equity via dividends or share repurchases. So clearly down here, you're trying to reduce that debt outstanding. Cash on hand will cost you money, but it's good for flexibility. You need to have some cash on hand for emergencies to take advantage of opportunities. Net working capital, costing you money, but again, you need it to minimize risk. You have to have some inventory sat on your balance sheet, for example, to make sure you can meet sales demand. To generate returns, you want to spend it via CapEx and acquisitions. What drives your WACC? Well, the sources of capital you're using and the cost of each source. Where's it coming from? Maybe CFO. Hopefully, if things are going well, you are generating positive CFO, and you can fund CapEx projects, acquisitions internally. CFO, and it says net working capital if that net working capital is negative. It's working for you. You are effectively using your suppliers to finance your business. Or you issue debt or equity. In the long run, your two classic sources of finance. In the short run, okay, you may finance operations by selling off some assets. Clearly, that is not a long-run strategy. As we've seen from corporate issuers, your cost of capital, your weighted average, comes from your debt and your equity. If you're a profitable company, you can also finance projects internally using CFO. Let's see what's going on with Warehouse Club, our fictional walkthrough example. On the left, we have our sources, and on the right, our uses. What jumps out at us? Well, let's start with our sources. Where did our capital come from for the year? So this is, I say for the year, for the period 2010 to 2019. So for those 9 years. Only 2 sections to those sources of capital. CFO and a little bit of debt. Over that entire period, no new equity was issued. It was only debt. But compared to CFO, it's a small percentage. And what's more, if we compare that amount of debt issued to our increase in cash and investments on the balance sheet, it's smaller. They are not making a huge use of debt. Almost everything is financed internally through CFO. What are they using that capital for? Some of it is sat on the balance sheet. As we've said, more than has been issued in debt. Some has been given back to shareholders. So kind of tracking across to here to about 80 and about 40, around 40% going back to shareholders via share repurchases and dividends, roughly equal to CapEx, about 40%. The amount they've given back to shareholders and the amount they've spent on projects via CapEx is about the same. There were no acquisitions, so it's all just CapEx to try and grow. But one thing we can say for sure is they did not use much debt. Why? It may be because they don't like the idea of financial risk. Raising debt finance increases financial risk. Why? Because it will increase the volatility of your net income. We can measure the degree of financial leverage as the change in net income or the percentage change in net income given a percentage change in operating income. The difference between these two, interest. The higher your interest, the greater your financial leverage, the bigger the change in net income given a change in operating income. So it may just be that Warehouse Club does not want to expose their equity holders to financial risk. You can also measure it using interest coverage, which we met back in FSA. Interestingly, no pun intended here, they define interest coverage as EBIT over, I just put it in quotes here, interest. Now, you decide what interest figure you would use. We talked in FSA about there being issues with capitalization of interest. And if you pick interest expense from the income statement, you're not getting all of it. I'd rather use interest paid. They do mention interest expense here. You're not going to get a question wrong by using the wrong one. They'll make it clear what they want you to use if there was a calculation required. So let's finish off by taking a look at the return on invested capital and the WACC of our fictional warehouse club. And we can see from that top chart, the WACC has remained fairly constant. This is your WACC here. It's kind of fairly constant, probably declined a little bit, if anything. Compared to your return on invested capital, which is this line here, you can see it's a positive gap. Tremendous news. We're generating a positive spread of our ROIC minus WACC. Also makes the point here, look, if you exclude cash and it kind of calculate ROIC without that cash, they can get a big jump. Where does it go from? For about 12 to about 24, 25, kind of, 15, 16, 17 basis point increase in ROIC. So, are they struggling to find new stores to invest in or to use that cash? Because they've already given a lot back to shareholders. Who knows? But it is positive. It just begs the question. Degree of financial leverage is hovering around about 1. Net debt to EBITDA has fallen. So your total debt less cash on hand compared to your profits is going down. They certainly do not have a high degree of financial risk by any measure. Remember, if your degree of financial leverage is 1, that doesn't mean you have, some. It's higher than 0, so it's some financial leverage. If you have no debt, your degree of financial leverage is equal to 1. How on earth, then, can it dip below 1? Well, I think that's a function of how they're calculating it. If you calculate using net interest from the income statement, so you're netting off interest expense and interest income, if you are earning more on your investments, and certainly they have cash lying around, if you're earning more than you are paying out on the debt you've raised, then you could have a degree of financial leverage less than 1. That must be what's happening here. They've got net interest income. And that's it. As I say, most of that is a walkthrough of an example. We've walked through the Warehouse Club exhibits for the most part, the interesting ones at least. There is another fictional company for you to walk through. All I'd say is look at this learning module and the next 2 that follow as application of what you've already learned. We pulled in economics, we pulled in corporate issuers, we pulled in financial statement analysis. Don't expect to be examined on the specifics of Warehouse Club or the specifics of anything we've talked about here. It is just practice in applying everything we've seen.